our monthly live stream. So we do this because we know that crypto taxes and dealing with them can be stressful, they can be overwhelming, and we just wanted to make sure that investors like you had the information they need to be more successful investors. So we know that things are kind of rough in the market right now. So we'll discuss some strategies for tax saving. Um, but right now, I do want to introduce our two special guests. First off, our head of tax strategy. He's also the owner of a crypto accounting and crypto legal firms, Jordan Bays. How's it going, Jordan?
Going well, Daraj. Hopefully, everyone's still in the market and it's going well for them as well. It's tough times, but we'll talk about some things that we can do maybe to save ourselves from perspective.
Oh yeah, oh yeah. Excited to get into that. And also our director of tax strategy. He has years of experience preparing tax returns for high net worth individuals. Miles Brooks, how's it going, Miles?
Hey, excited about the stream. There's a lot of opportunity when the market's down for tax savings. So it's a good time to be talking about this stuff and thinking about this stuff. So there is kind of a silver lining to the market being down.
Yeah. So I do want to ask you about that, but first off, short little disclaimer. This session is for general informational purposes only. If you have any specific questions pertaining to your unique situation, please reach out to your tax professional. Well, now that we got that out of the way, I mean, obviously, the big story right now in the crypto ecosystem is Terra and Luna. So, can you tell us a little bit about if anyone's watching who held either of those assets, how they can write off any losses that they incurred? We'll start with Jordan, then go to Miles.
Yeah. So it's a difficult thing, right? It's a difficult situation. Anytime we see a significant depreciation in value of an asset, but when we're talking about the Terra ecosystem and Luna and UST, there were billions and billions of dollars worth of money, tied up into those ecosystems. So a lot of people have significant losses, whether that significant dollar amounts to them or significant dollar amounts to their businesses or funds. There were many people using that anchor protocol to generate passive yield. And unfortunately, for most people that are investing in these assets as investment, right? They're holding it as a capital asset in their hands. There's still a value, Luna still has a value, even though now we've kind of migrated to Luna 2.0 and UST still has a value. So in theory, when that value has gone down, if you were to dispose of that asset for, let's say, a different stable coin, or you're ultimately ending up from Luna or UST into a USDC or ETH or whatever the case may be, let's say, if that's the position that was taken, you have these capital losses. For many people, they can be significant. For those people, they can utilize those capital losses to then subsequently offset some capital gains in the future. Or if there were gains earlier in the year, right? If maybe the position was built up where there was a lot of UST or Luna that was being held because of gains that were accrued along the way in this tax year in 2022, those losses can be used to offset stuff that happened, let's say, for the first 5 months of this year. Unfortunately, the problem that I'm seeing, and I'm sure Miles, you're seeing it in Garage as well, is that a lot of people in that ecosystem were generating massive amount of gains in 2021, which tax is going to be owed on those, gains. And then after that, having a very terrible thing happen in 2022 with these losses. And unfortunately, it's terrible, but we can't, carry back those capital losses to offset those prior year gains. So in a way, there's a little bit of handcuffing going on where it's not the most ideal situation. But there are strategies that can be put into place to kind of mitigate future tax burdens, right? Depending on people's situations, there could be some other things, maybe. But at a high level, the straightforward answer is you have these losses that can be used to offset gains, but we can't, unfortunately, go back in time and wipe out some of those gains that were built up in that value in the UST, or let's just say in the Luna ecosystem that was accrued last year. There still will be that liability.
Right. So capital losses can be carried forward, but they can't be taken backwards, unfortunately. I
Correct.
mean, Yeah. So Miles, anything you want to add on to that?
Yeah, I think it's important for people to understand and realize that Jordan kind of touched on this in the beginning, that just because the price has gone down a lot, you have now unrealized capital losses. And you have to realize those losses by trading, by selling, etc., in order to then report those losses on your tax return. There is potential at some point that the price will continue to have a market, and people will continue to trade Luna, kind of in a casino-like way because everything's shifting to Luna 2. But it's kind of that idea that people are still trading for these coins, though they're not necessarily totally worthless. So it's very important, put yourself in a good situation, realize those losses rather than just hoping you can claim worthlessness in the future when you file your tax return.
Right.
Right. Correct me if I'm wrong here, Miles, but like I think the rule around claiming unrealized losses is there has to be no reasonable expectation of a profit. But then there, you kind of see these like meme traders going into Luna now just to hope to get like a 2x or a 3x.
That's right. That's right. So when you're claiming worthlessness on an investment, there can't be any reasonable expectation of return. And so, just like we mentioned earlier, there's still a market and you could still potentially gain, or you could still like trade this Luna. So there is an expectation of, some return maybe. And so I wouldn't say it's very smart to claim worthlessness. Um, you can claim your losses, you just have to sell and realize those losses.
Got it. That makes sense. That makes sense. I'm sure there's a lot of people out there who also, maybe they weren't holding Terra and Luna, but just because the ecosystem, everything's down right now, they might have the opportunity for tax loss harvesting. So, for anyone who might not be aware, can you give us a quick synopsis of what tax loss harvesting is and how someone could get started doing it? We'll start with Miles and go to Jordan.
Yeah. Tax loss harvesting is the idea that when, if your investments are in a kind of down position, they're in a loss position, you want to sell, realize those losses, and use those losses to offset any gains that you have. It's important to remember that, Jordan was touching on this a bit, we're based in a calendar tax year. And so, every year we're filing our tax return for a full year, January to December. And so it's really only in that time frame that kind of everything is compiled into a single tax year and you report your taxes. And so, when doing this tax loss harvesting, if you're not tax loss harvesting now, you're going to want to at least, by December 31st in order to claim those losses for the 2022 tax year. The good thing is CoinLedger really has a great tool for tax loss harvesting. When you plug in all of your information, we're able to identify for you the biggest opportunities that you have for claiming losses. And so that tool is a great tool for anybody to use. And so highly recommend people check out that tool in order to see what their biggest opportunities for claiming losses may be.
Sweet. Yeah. Well said. Well said. Jordan, anything you want to add on to that?
No, I actually just want to second what Miles said with having a software solution or any solution, but specifically something like CoinLedger where you can actively, right? It's not like a passive thing. We're doing this once a year. I mean, some people do that with their crypto portfolios, right? But if you're actively managing these positions, in theory, right, what's underwater and what's in profit, but you might not know definitively how that's going to impact you from a tax perspective. So everything that Miles said about harvesting and losses and making sure that you're realizing and recognizing these losses is 100% perfect. Just make sure that when you're using this software, when you're using CoinLedger, where you're using any tools, that you actually get the value out of what's there, because those things that you can do from a tax perspective, leveraging a software like that, or just analyzing your portfolio and seeing where you can harvest these losses, they pay dividends down the line. We have the ability now. It's terrible. It sucks. It's not good. But when the market is down like this and your position's down 20, 30, 50, dare I say, maybe even 80, 90%, it's possible you're still holding on to these positions, but you believe in that project. It doesn't make sense to not harvest a loss there, right? Maybe you acquire it at a lower price in the future. Maybe you buy it back and it looks like a bona fide sale and you're repurchasing the asset and it's something that's allowed. But the only detriment to doing that is changing your holding pattern. But right now, when prices are so depreciated, that might not be such a bad thing to get and enter into short-term holdings until you wait another year, right? So everything Miles said is what you should be doing. And there are tools out there, specifically with CoinLedger, that can help you do that, right? So actively managing your portfolio is not just taking positions and taking profit. It's also doing this from a tax perspective, which people have been learning, of course. And this is way different than 2017, 2018, in my opinion, where people had no idea about the tax ramifications. Now I'm seeing a lot of clients and I'm seeing a lot of people reach out about this, being proactive, not waiting from advice from the professionals. They're seeking the advice, or they remember if this isn't their first cycle where this has happened. So it's rough. It's not ideal, but it happens. And we have to try to find a silver lining. And the silver lining would be the tax loss harvesting that we can use to offset those future gains that will come. The market will turn back around at some point. And when you have these losses built up, it's nice to know that you could have this big gain event, this big tax triggering event in the future, but maybe there's no real tax consequence.
Got it. That's super well said. Yeah, I mean, I just want to echo that. If you're somebody who's bought an asset like multiple times and you have it spread between multiple wallets, it can be so hard to tell, whether it's underwater or how underwater it is. So having a tool like CoinLedger is so helpful for a scenario like that. All right. I think it's time to hop into audience questions. So here's one we got from Twitter. Someone asked about the tax treatment of depositing and withdrawing LP tokens from DeFi protocols. I guess this would be like, if you want to contribute some liquidity to something like Uniswap and you want to give some, some ETH uni, you contribute that trading pair so you can make money off the fees that are generated. Miles, you want to take this one?
Yeah, definitely. This is one of those kind of tricky situations, a little bit, but generally when you're going to combine two assets together into a liquidity pool token, that's going to likely be considered a taxable exchange. You're basically in a way exchanging away your tokens for a new asset, a liquidity pool token that then can be used and staked, which is a great tool, but I think what's important to realize is, it's like a type of wrapping event in a way. And so people may say, oh, well, it's possible this is not a disposable event. It's possible that, you're really just combining two assets together, and you still kind of own those two assets, just maybe in a different form. They're wrapped, they're slightly different, but not maybe materially different. I think it's important to realize that with these liquidity pool tokens, you're exposed to items like impermanent loss. And it's kind of those factors that kind of come into play with the liquidity pool token that makes it look like it should be a taxable exchange, because there's different economic realities you're facing when you're holding these two tokens separately. And you're in a different economic situation if you combine them and wrap them together into a liquidity pool token. And it's that difference in kind of economic situations that establishes that this is most likely a taxable exchange.
Got it. And the same thing would go for, withdrawing your liquidity if you want to do that.
Exactly. Kind of going the other way, that's also considered a taxable exchange from the liquidity pool token back into your two tokens.
Got it. Got it. That makes a lot of sense. Jordan, anything you want to add on to that?
No, I think that that's probably I mean, we don't really have definitive answers on this, right? And because we have the right to, like Miles said, you have the right to redeem the assets, the underlying assets that you provided the liquidity with. There's a ton of things that go on before you do that, right? You can get these LP token. There could be, like Miles said, some impermanent loss. You can use some of these LP tokens and place them in different protocols and earn even additional yield. So it does look like it's a different asset. There are arguments that maybe, like exactly like Miles said, that it's a non-taxable event, but I think when you see the fluctuation in the value of that underlying LP token, because that there is difference in value when you actually provide and remove, it's probably accurate and it's definitely the conservative approach and the approach that most people take, that that's a taxable exchange, because of all the things that Miles alluded to. Some people want to maybe say that that's not, and that's up to them and their tax professional to determine what position they want to take. But I think consensus, with definitely software solutions and most practitioners, is that that should be deemed to be a taxable event, both ways. Now, are there ways to maybe analyze your particular portfolio, see what your situation looks like, and see if maybe that's not the right choice for you? Maybe it's jurisdictional based. Maybe you're not in the US. Maybe there's different treatments around the world, but you still use CoinLedger software. Sure, that's a viable thing to maybe look into. But I'm confident, and I know, Miles, we've had this discussion many times, and you as well, Daraj, that that's probably the safe route and the most conservative, and also most likely what everyone that's the consensus for now. A little different than wrapping tokens in certain ways, and a little similar. And Miles has done a lot of research on this stuff, so he's very in tune with the wrapping mechanisms, right? But yeah, I don't really have much to add from like a tax perspective. I think that it is what it is. I think these instruments will start to get a little more sophisticated. It's definitely more sophisticated now than it was 2 and 3 years ago. And maybe there are different structures that will come up that don't look like taxable exchanges. I don't know. There already are some, but then you get into different issues, different tax issues, different revenue, different recognition event issues. So it's an ever evolving space. Usually during this time in this bearish market, we see a lot of things being built out. So maybe even next month we have a discussion and we have a different structure and we change our minds about certain things, right? But for now, I totally agree with everything Miles said.
Got it. Got it. And kind of a follow on to that. How would you calculate your gain or loss from, depositing and withdrawing LP tokens? Any thoughts there?
Well, I think it depends. I'm not sure exactly what is going on with you. Maybe Miles can allude to that on the CoinLedger software with the deposit and withdrawal, but there's a value. There's a market value of these assets upon deposit, and there's a market value of the assets upon withdrawal. Technically, that'll establish basis in that LP token, and when the LP token used for redemption, you would dictate what the gain or loss on that event is. Now, you also are earning yield, which will be ordinary income, right? And like Miles mentioned, there could be some impermanent loss that will have a little bit of, there will be some sort of consequence there to the overall gain and loss in that position. But high level, that from a tax perspective, from a financial perspective, when you're looking at the value of the asset in your wallet, it makes sense, right? What you put in, what you put out, see if there's a discrepancy there. There's a little more to it because of the income that you're generating as well, that we're treating as ordinary. But high level, that would be the position that you would take to determine that gain or loss.
Yeah, I can echo some of that. It's going to be treated just similarly to token exchange. You're going to have basis in your assets based on the value when you acquire them, and then when you dispose, or trade to the LP tokens or come out of the LP tokens, you're going to have a value, the proceeds, and the difference between your proceeds and your basis is going to be any gain or loss that you may have on those transactions.
Okay, well said. Well said. So here's a question from the chat. Someone asked about the legality of margin and leverage trading in the US, and then how are profits from margin treated from a tax perspective. Jordan, you want to take this one?
Yeah. So there are some platforms in the US that do allow for leverage trading. But the ones that do, from what I understand, based on conversations with clients, have changed their protocol significantly, where you have to have, most of them, not all, a significant amount of US dollar value in your account in order to do that, right? That's number one. That's for something like, we could say the name, like a Kraken account, right? For another exchange that is allowing for margin trading, if they're allowing it and it's a US based exchange, when you've KYC'd, it's not illegal per se, but most of these exchanges will not do it because of the uncertainty, number one. Number two, they're usually these transactions that we're seeing with a lot of margin trading, leverage trading, they are on the international exchanges that technically have banned U.S. citizens and U.S. domiciles. Most of them, not all, but most of them do. And that's where a lot of the activity is occurring. So in theory, that wouldn't make it illegal per se in the US, but it would be restricting, right? You wouldn't have much access to these exchanges. So the ones in the US that we do have access to, that we can trade on margin, you can do it. It's not illegal to do that, but there is limited access to those accounts and those exchange accounts in the US. So for some person that's in the US, but is maybe a dual citizen, I mean, there are people that have still access to international exchanges. Maybe they're doing that on something with more volume, but it's not illegal per se. Now, if you're utilizing, and I know I don't advocate for this, but I'm just saying some people maybe utilize some of these exchanges that are not US based, that don't KYC, and they do have those sort of vehicles for you to invest in. Just because the U.S. exchanges, and this isn't, I'm consult with your tax professional or your tax lawyer, but in my opinion, just because you have access to an exchange or an account that maybe isn't KYC and maybe isn't a U.S. based entity, you still pick up that activity. You still pick up that income, because that's where somebody would get into a big problem. Disclosure is something that we see in this space. And we've seen in the past when we're talking about foreign accounts, international activity, and the same thing goes for crypto. It's not some magic thing where you're on an exchange that is abroad and hasn't KYC. You report that activity, you pick it up, you won't run into any issues with the IRS. And oftentimes, I hate to say it, but people that are trading on margin, they lose money. And if you have losses, you want to get the benefit of those losses as well. From a reporting standpoint, it is similar to what we see with traditional trades. But there's, when you're trading on margin, you're borrowing, you might have to pay some interest. There's a different P&L kind of calculation on those exchanges that then subsequently would be transposed onto your tax return in the same forms, but they maybe have different flows of how you would want to account for them. And that's honestly, most of the time, from what we see in practice, and Miles, I know you could allude to this from the software, the transactions populate a lot differently than the token-to-token swaps or the DeFi NFT stuff. So that was a long-winded answer, I know, but it's important to know that it's not necessarily illegal, but you can do things that can put you into hot water. And I definitely don't think that people should be doing those things.
Got it. That makes sense. Yeah. Calculating margin trading, as Jordan alluded to, it can, like, the capital gain or losses from that can be a little bit complicated. But at the end of the day, what you're doing is just like, you're reporting your gain and you're reporting your loss that you made from that activity. So Miles, anything you want to add on to that?
No, I think, important to realize that all income, doesn't matter the source of the income. I don't think it's not illegal to margin trade. Even if you're using a VPN, you can be restricted in certain ways and still find a way to margin trade. It's not necessarily illegal. The attention will be put onto the exchanges rather than onto the individual level, in terms of like compliance and that sort of thing. But doesn't matter where the source of the income comes from, it needs to be reported on your tax return. And there's kind of like a funny, idea that like all income is taxable, even illegal income. And so if you're doing illicit activities, selling, drugs or whatever, that's how they got, these big mobsters, is because they had all this illegal income that they didn't pick up on their tax return. And so that's not this case, but it is kind of important to note that doesn't matter what the source is, you got to put it on your tax return.
Yeah, it's kind of funny. We tweeted this out from the CoinLedger account a few months ago, but the IRS has guidance on income that you earn through stealing things. It's pretty hilarious.
Yeah. Income from whatever source derived is income. Income is income is income, right? And so if you do happen to pay tax in a different jurisdiction, of course you can get the credit for that. There's foreign tax credit. There's there's income credits from earning income abroad, but you still have to pick that up on your U.S. return, and you'll back it out with whatever tax credits you get or whatever credits you get for having foreign earned income, right? The foreign earned income exclusion. But you still have to report it, just like Miles said. International, income, illicit activity / criminal activity, it's got to be reported. So just do it. Don't get into that issue. That's not an issue you want to have.
Yeah, well said. Just do it, guys. So I think that's a pretty good place to end it. So if you're interested in getting started with CoinLedger, we've helped over 300,000 investors across the world file their tax returns. Click the link in the description. You can get started with a free account, start connecting your wallets and exchanges, and you don't have to pay for a tax report just yet. You can just see how the platform works for you. Jordan, Miles, you want to tell the audience how they can reach you?
Yeah,
So,
you guys can reach out to me on Twitter at Taxing Crypto, or send over an email either at the law firm Bass Law or the CPA firm Taxing Cryptocurrency. You could find that online, Google, Twitter, any search engine. If you have questions, if it's not me, if it's not Miles, if it's not Diraj, reach out to somebody, because you don't want to let those questions linger. So no matter what, you have a tax question, it's crypto related, get the answer, because it could mean a lot from your tax situation, right? Every day, we see crazy price fluctuations, we see things happen, and you want to make sure that you optimize. I know it sounds weird, but you optimize your losses so that you can optimize those future gains.
definitely. And Miles, how can the audience reach you?
Yeah, find me on Twitter at Miles Brooks Tax. I'm available for questions anytime. So, reach out to me through message or tweet me. I'm available to kind of help guide for some any tax questions. So, hit me up, Miles Brooks Tax.
All right, awesome. Well, have a great rest of your Friday, guys, and